Good morning. Myself Sai Darshini and my co-mate Janani of second year BCom LLB, Shastra University, are here to handle the topic balance sheet. Before going deep into the topic, we must first understand what is the concept of balance sheet. A financial statement that shows the financial position of an entity at a given point of time. In nutshell, it is a status report at a particular point of time. Balance sheet deals with two aspects, assets and liabilities. Balance sheet have a specific structure or form, that is assets equal to liabilities. If you are a shareholder of a company, you are a potential investor. It is important to understand how the balance sheet is structured, how to analyze it and how to read it. Assets are what company analyze it and how to read it. And assets are what a company uses to operate its business, while its liabilities and equity are two sources that support these assets. Owners' equity referred to as shareholders' equity. In a publicly traded company, it is the amount of money initially invested into a company plus any retained earnings, and it represents a source of funding for the businesses. It is important to note financial position at a single point in a time. A balance sheet along with the income and cash flow statement is an important tool for the investors to gain insight into company and its operation. It is a snapshot at a single point of time, and the company accounts covering its assets, liabilities and shareholders equity. The purpose of the balance sheet is given interested parties an idea of the company's financial position in addition to displaying what the company owns and owes. It is important that all the investors must know how to use, analyze, and read a balance sheet. A balance sheet may give insight or reason to invest a stock. Typically, a balance sheet is prepared at the end of a set period. For example, it can be prepared at the end of every quarter, or some companies may prepare it annually. Left side lists the assets of the company. The column on the right side lists the liabilities and the owner's equity. The balance sheet present a glimpse into how the company is doing financially. One of the key ingredients is the debt ratio, which is the ratio derived by comparing total debts to total assets. As I stated above, the balance sheet is an important clue to a business owner about how his or her company is doing. A balance sheet summarizes an organization or individual's assets, equity, and liability at a specific point of time. Two forms of balance sheet exist. There are the report form and the account form. Individuals and small businesses tend to have a simple balance sheet, and the larger businesses tend to have more complex balance sheets, and these are presented in the organization annual report. Large businesses also may prepare balance sheet for segments of their businesses. A balance sheet is often presented alongside one for a different point in the time for comparison. Balance sheet substantiation is the accounting process conducted by businesses on a regular basis to confirm that the balance held in the primary accounting system for recording or reconciled with the balance and transaction records held in the same or supporting subsystems. Balance sheet substantiation includes the multiple process including reconciliation of the account, a process of review documentation, and a formal certification of the account in a predetermined form driven by the corporate policy. Balance sheet substantiation is an important process that it is typically carried out on a monthly, quarterly, and also year-end basis. The results help to drive the regulatory balance sheet reporting obligations of the organization. Historically, the balance sheet substantiation has been a wholly manual process driven by spreadsheets, email, and manual monitoring and reporting. In recent years, software solutions have been developed to bring a level of process process automation, standardization, and enhanced control to the balance sheet substantiation or account certification process. These solutions are suitable for organization with a high volume of accounts and are personnel involved in the business balance sheet substantiation process and can be used to driven efficiencies, improve transparency, and help to reduce risk. But owners are not only people looking at the balance sheet. Lenders typically look at the financial statement. Investors, and when you put in the company up for sale, buyers also look at your balance sheet to help access the company's financial position. Now, let us see the views of looking at the balance sheet. There are two views. Firstly, the resource and claims view, in which the assets look into economic resources of the entity and the liabilities took into the claims against the resources as on the date and claims of the outsiders, that is bankers, owners, vendors, employees, and so on. Another important aspect we must be aware of is mainly deals with two components of liabilities. One is shareholders liability, which is also called owners liability, and the next is other liabilities, that is liability of vendors, employees, and so on. When shareholder equity is greater than the book value, if the equity has increasing growth potential. When the shareholder equity is lesser than the book value, if the equity is considered as sick. Secondly, sources and funds view. In this assets will be formed in the fund is utilized or invested, and the liability deals with sources of funds. The assets are the economic resources that are controlled by an entity whose cost of acquisition is objectively measurable. Following by this, to understand the concept of balance sheet clearly and more precisely, my co-med Janani will be handling with the illustration.